All right, we're starting.
Me too.
And it's still 6 o'clock. I'd like to call the meeting of the pension board of April 10th, 2024 to order and approve of and seek approval of the minutes from March 13th meeting.
I didn't see any problems, so I'll move to approve the minutes.
Second, all in favor? Aye. Opposed?
Yes.
Abstained, passed unanimous, one abstention. Is there any public comment? No public comment, we'll move on. There are no pension applications, if that's correct, right? So then we're gonna go on to the investment policy statement. Britt?
Nice to see everyone tonight. Can you hear me okay?
Yep.
Yes.
Yep.
So based on our conversation last month, we updated the investment policy statement largely on page 11, which outlines the targets to the asset classes as well as the ranges around each asset class. So as discussed, we reduced the global equity long short target allocation from 8 to 4%. And adjusted the ranges on both the upper and lower accordingly. And then we increased the cash target allocation to 4% and increased the upper limit to coincide with that. Along the same lines, you'll see the total equities target has been reduced from 69 to 65%, reflecting the 4% reduction in global equity long short. And we lowered the lower range for total equity accordingly. So those were the main changes that we had with the IPS. I think for the most part, the rest of the document is still in good shape, but happy to answer any questions or discuss it further.
There's one,
Only question I had, we've had discussions about where we want to land on securities lending. This still has us permitted to do that. Is that where we want to stay? I mean, I think the last time we discussed this, we agreed it was kind of de minimis, but since we discussed it, I just want to make sure everyone is still on board with that.
I think giving us the option to do it is reasonable.
Yep,
How-
I agree.
Make a decision to do it or not to do it, and right now we've made a decision not to do it, so it just fits with us.
Okay, yeah, I'm fine with that. I just want to make sure we all agreed.
I do have one very minor point that I'd like to make is in the philosophy, in the third paragraph. It says this,
What page?
well, it's under investment policy and philosophy. And in the third paragraph, it says this, if anybody has it, everybody has this, it says the sole interest of the board shall be on behalf of the funds and various funds in the interest of the participants. I would like to add in the financial interest of the participants, just financial, the word financial. And although this sounds minor, I just don't want to be in a situation where at some point people say, well, the interest of participations is the environment or any social issue at all. I don't know, if no one probably ever reads this, but we do, but
There were discussions of that some years ago and got very heated at times because several people said the only question is our fiduciary responsibility to maintain the finances of the funds, maintain the financial integrity. So this is actually good.
would you agree to add that?
I would agree to add that, yes.
Can you repeat the language?
Sure.
You want to say?
Oh, yeah.
Just add the word, just add the word.
Yeah, the financial, that's
On
all.
the financial interest rather than just the broad interest.
Because I did have some discussions with some members of the city council because they talked about diversification, environmental and social issues. And I just said that, we are really focused on the finances. So I don't know if anybody wants to move for that to be added.
Well, we have to approve the whole thing. That's your only,
That's the only thing I wanna change, is to add that one single word.
I move we adopt and approve the changes first on page 4, paragraph 3 of philosophy, and page 11, the changes in Schedule A, asset allocation as written.
Before we do that, I have a question on page 6. Point 4, the social investment policy. Does that in any way conflict or in any way impact the change you just made? And is that policy consistent with that or not?
Actually, yes, because what section, we had numerous discussions of this section in the past. And basically it says that we are aware of it, but we're also aware that we will be guided by our ultimate responsibility to provide benefit payment.
Right.
So our ultimate responsibility is financial rather than social.
Yeah, so it's not a conflict, actually, if anything, I'd say it reinforces.
Yeah.
Okay, all right. I want to make sure that it just does not conflict. That's my main concern. So I'm fine with that.
It actually reinforces, as you said, and makes an improvement.
So there's a motion, is there a second?
I'll second that.
All in favor?
Aye.
Opposed? No, one abstention? Unless you.
I'm good. I'll vote.
Okay.
Yeah.
Good.
I had to abstain before because I
Right,
wasn't
for
at
the,
that meeting.
you were here for the
Yeah.
minutes, right?
Yeah.
So it passes unanimous? Perfect.
Great, we'll circulate the final version to everyone before the end of the week.
So it's gonna be a brief meeting because we don't have anybody here tonight, and we also, we're gonna go over, well, you wanna go over review right now, Britt?
Sure, unless you had another topic you wanted to discuss.
I'll actually discuss it when you go over the review.
Okay. So we have the February flash report. Just to give you a bit of a high-level overview of what happened in February, since we're now in April. Equities, both US and global, had strong performance. And fixed income was posted negative returns as we saw persistent inflation data being released, and we've seen that again being posted today. US equities were up almost 5.5% in February. Growth continued to outperform value, and large cap continued to outperform small cap. Within international, equities were up about 2.5%, and we saw a similar pattern with growth stocks being up more than value stocks. Within the fixed income markets, I think, the data coming out is not necessarily in favor of interest rate cuts in the near term. I think the expectation coming into this year was 6 cuts. It's been reduced to 3. Kevin and I are in San Francisco for our national conference, and we heard an economist today. He kind of pointed at, not seeing a cut until maybe the fall. So we'll see how economic data continues to come out, but the economy appears to be very strong, and that data is informing how the Fed reacts. In terms of the pension plan, on page 3 of the flash report, you can see total assets about 506.8 million, consistent with past months and quarters. US equity is overweight given strong performance that we've seen over the last 15 months or so. We will adjust these targets to be effective with the April flash report. In terms of other overweights and underweights, you can see private equity slightly overweight, but again, we expect that to come down over time as these funds continue to make distributions. And fixed income is underweight, but within the range. And then you can see the absolute return overweight, but that target is increasing, so it will be largely in line. We have performance on pages 4 and 5. Again, on an absolute basis, we've seen very strong returns from the portfolio. In particular, LSV continues to do well in their deeper value style. You can see over the last year, up about 250 basis points over their benchmark. And over the last 3 years, up almost 700 basis points over their benchmark. And they struggled for a while, 3 or 4 years ago, and it's glad to see that their process is really coming out in performance. Principal Dynamic Growth, you can see, has trailed over the fiscal year. They trailed significantly in the fourth quarter of last year. You know, a large part of their underperformance over the last year or so has been driven by healthcare as well as financial stock selection. You know, longer term, this fund's done very well for the city, but we would recommend having them in probably in the fall to do a portfolio review. I think given the changes that we've seen there and their underperformance, I know we had them in last year, but it makes sense again to have them in, make sure that the board understands what's driving their process and performance, and making sure that conviction still lies with the manager and the strategy.
Hey, Brett,
Yes.
can you make a note for when we invite them, is to talk more about what they're doing to get better and make better decisions rather than just talking about their favorite names and how wonderful they are?
Absolutely. Yeah, that's good feedback, Rich. Thank you. International equity markets, you can see up 7.3% in totality fiscal year to date. Silchester continues to do well. You can see over the last year and longer periods, they've done well. Walter Scott has done very well in the fourth quarter and year to date. Most of their underperformance was really due to when Norwalk subscribed to the fund and made the change. That first quarter of Norwalk's experience is really leading to that underperformance, but overall, we have no concerns with the team or the strategy. ABS continues to do a nice job. You can see up over 11% for the trailing year. Being a little bit net long has certainly helped in this equity market that we've seen. And then finally on page 5, your fixed income managers, while not earning as much as your equity managers, they've certainly done fine against the benchmark, and UBS and PIMCO continue to be great diversifiers for the portfolio while also generating a nice return. So fiscal year to date through February, the plan's up 8.2%. Most of the relative underperformance versus the benchmark is driven by that Principal Dynamic Growth strategy and their underperformance. But longer term, you can see over the 5 and 7 year periods, returns well over 7% and ahead of the benchmark. Any questions on performance?
Not this time.
No questions? Okay, thank you, Brett. Any other matters to bring up to the board? If not, is there a motion for adjournment?
Adjourn.
Is there a second?
Second.
I'll second.
All in favor? Aye.
Aye.
Nope, thank you very much. We're gonna move on. Hey, you know, I know. You know, oh, you know what? Before we start the next meeting though, maybe, because there are 3 board members right now that are zooming in. So maybe you would like to just introduce yourself now and you can talk about your experience or what your favorite foods are, whatever.
Of course, it's pizza. Yeah, so good evening, everybody. My name is Jared Schmidt. I'm the new CFO for the city. I just started last week and getting my feet underneath me. I was coming from being the CFO at Fairfield, town of Fairfield, where I was there for 3 years and also served on their pension board there. So a lot of the the information and processes and documents and basic foundation looks familiar to me, and similar allocations. So I look forward to. I've heard good things about the board, and look forward to working with all you guys.
Excellent,
Thanks.
thank you. Okay. Actually, we're supposed to wait until 6:30.
Oh. Sorry, too early.
I know, but that's okay. I don't think anybody's gonna check on it.
Mhm.
Right. By the way, that is about the shortest meeting we've ever had, because they're in San Francisco and we didn't have anybody coming in except now for defined contribution. Okay?
Yeah.
So I would like to call to order the meeting of the defined contribution plan for April 10th, 2024, and review and approve the minutes of January 10th, 2024 meeting. Anybody have any changes? If not, is there a motion to accept the minutes?
I'll do a motion to accept.
Excellent. Second,
I'll second the motion.
all in favor?
Aye.
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 Opposed? No. One abstention.
I'll abstain.
Any public comment? There's no public comment. We're gonna move on to the capital group. It's gonna discuss the target date funds. And if you gentlemen would like to introduce yourselves.
Absolutely. First and foremost, thank you for allowing us some
Thank you
time
for
today.
coming.
I'm Mike Koch. I am a business development manager and vice president with Capital Group. And today I'm joined by Jeb Bent, who is one of our investment directors, who covers the multi-asset funds for the American Funds Collective. And he is dedicated to supporting the target date efforts and ensuring that we help clients such as yourself just develop a better understanding of how they work, what's going on with them, and answer any questions that may come up. So today we realize we're a little compressed on time. We only have about 25 minutes. Is that correct?
You probably got a few more. since
Yeah,
the other
a few
meeting
more.
went So quick.
Yeah, and we have some questions, so don't worry, you'll be here more than 20 minutes.
So we'll keep it short, but we want to make sure that we're answering any and all questions
Mhm.
that you may have regarding the strategy, especially with how important it is to the participants within the plan. So with that, Jeb, I'll turn this over to you. We do have some hard copies. Is there anybody in attendance? Go ahead and get these. Thank you.
Bet you're glad you don't have a Francis Scott Key bridge out here.
It was carefully selected, very carefully selected.
All right, well, thanks for having us. My commute wasn't too bad of a commute coming in from Manhattan, so glad to be here. My good friend lives in Newport, and we have quite a few of our colleagues kind of in the New Canaan, New London area. So these are quarters that we make our way up kind of the Metro North. Although we did take a car up here, it's going to be a little bit of an easier commute on the way back. So I guess where we would start really quickly on the Capital Group, won't spend too much time here, but on page number 5, as you can see, we were founded north of 90 years ago. Our core mission at the onset of our organization is to lives through successful investing. And that is true to the $2.5 trillion that we have in AUM. And as you can see there, north of $700 billion in multi-asset strategies. A few differentiators about our organization relative to other asset managers. We're privately held, so that allows us to be quite long-term in our thinking and not be beholden to short-term views of possible shareholders, number one. Number two, we are guided by experienced portfolio managers, and that is really critical to how we've been able to generate really strong returns for our 90 years. And then lastly, what's very unique is to how we manage our underlying strategies that make up our glide path is our multiple manager system we call the capital system. But as you can see on the bottom half of slide number 5, we are a leader in defined contribution. Many of our underlying strategies that make up our glide path are quite popular in defined contribution plans. Fast forwarding to slide number 9, so we can talk about our target date strategy. We have been around for north of 17 years. Our total assets, actually, if you were to take a look at, these are the end of year numbers, but our March 31st numbers are north of $300 billion in assets. Our glide path is managed 30 years through retirement, and we think that's incredibly important for a few reasons I'll lay out here shortly, but we believe a 65-year-old and an 85-year-old should have different portfolios. Next, nearly 70% of the underlying funds that make up our glide path have been around for 25 years or longer. So not only are we conducting a forward-looking analysis where we're stress testing our portfolio, but we can also take a look at how our portfolios have behaved over the course of time and how they behaved in different market environments. So that was incredibly helpful in our construction of our glide path. Now, what's most critical to our construction of our glide path is our objective. And it's the dual objective of building wealth and preserving wealth. Understanding that the vast majority of Americans just have not saved enough, we understand that they need more meaningful equity exposure, especially when they have lower financial capital and higher human capital as younger employees. And they also need global diversification, which is incredibly important. But also the delicate balance is not only being able to accumulate wealth in the accumulation period, but to be able to mitigate against some of the downside volatility that you will inevitably experience in a market environment. And we do that very differently by changing the types of equities that we own to more dividend-oriented equities that have historically been less volatile. And we also do that by owning more diversified and conservative fixed income, with a focus on low correlation. Now, the next slide, and feel free to ask any questions along the way here, slide number 10. This is our 8-person target date solutions committee that is spearheaded by our principal investment officer and chair, Michelle Black. Michelle is our multi-asset solutions portfolio manager, and she's joined by Samir Matur, Raj Paramaguru, and Wesley Flaw as multi-asset portfolio managers. And these 4 managers spend 100% of their time on solutions like our target date strategy, thinking about asset allocation. Now, the remaining 4 members are 2 fixed income portfolio managers and 2 equity portfolio managers. On the fixed income side, David Hogue and Shannon Ward. David has a focus on more core bonds, and Shannon has a focus on high yield or more credit-oriented bonds. On the equity side, Will Robbins has more of a focus on dividend-oriented equities, and Jessica Spacey has more of a focus on growth-oriented equities. So as you think of 8 individuals that are quite diverse in terms of their investment style and their key areas of focus, it is incredibly helpful as we put together our glide path to have a multitude of expertise as we think about constructing a solution for plan participants, not only in the accumulation phase, but in the distribution phase as well. What I would also point about these individuals is that each one of these individuals have a meaningful amount of their own personal assets invested in a target date series. As an investor in our own strategies, I have a meaningful allocation to our target date strategy as well. I think one may have said, don't trust a chef that doesn't eat their own cooking, and that's really important to us, for us to invest alongside our investors. But it's not solely these 8 individuals that are making the decisions. There's actually a team of 19 investment professionals referred to as our capital solutions group, and they're made up of analysts and portfolio managers with deep quantitative backgrounds. So just to give you an idea, Raj Paramaguru, who is actually part of this 8-person committee, he also wears the hat of research director, and he really spearheads our research effort as we think about glide path construction and asset allocation across our organization. We also have individuals that are keenly focused in on demographic analysis, and an individual by the name of Eugene Hahn. He joined us from the RAND Corporation, and when he was at the RAND Corporation, he had top secret clearance to conduct demographic analysis on, what we would call our adversaries who work closely with the Department of Defense. We also have a gentleman by the name of Ilya Lansky. His background is in theoretical physics. He has a PhD in theoretical physics. He's quite literally a rocket scientist, but his primary area of focus is quantitative modeling. And then lastly, we have an individual by the name of Iswari Balan. Her primary focus is on capital market assumptions. So we feed our capital market assumptions into the quantitative models that Ilya and team builds to help us land on our strategic allocation. And outside of that 19-person team, there's another 40-person technology.
We don't need any more people.
Oh, I'm sorry. We're gonna get the results.
You hire good people
Yeah.
or else you wouldn't be doing a good job.
No, absolutely.
Thank you.
So let's go to slide 11, and you know, the people's always a really good segue into our process, because ultimately it's not the results, it's the process that gets us to the results. So a lot of that input really is how the output is ultimately brought into our portfolio. So as we take a look at our glide path on slide number 11, this is very different than the industry. So as you'd expect, as a younger investor, you're gonna have a higher allocation equities. That's not different. And as you get closer to retirement, you're gonna have a lower allocation equities, a higher allocation of bonds, and that's not different. But what is different about what we do that is quite unique is the fact that not only are we lowering the amount of equities, but we're changing the types of equities. So as a younger investor, you're gonna have a healthy allocation of growth-oriented equities. So you're gonna own the Teslas and the Metas of the world. As you get closer to retirement, as I think of someone like my mother who's 70 years old, she's gonna own a lot less of those companies. She's gonna own a lot more Home Depot, AbbVie, or Gilead in her portfolios. Historically, those dividend payers have been a lot more resilient on the downside, and that has been a critical cog as to how we've been able to not only build wealth in the accumulation phase, but mitigate against the downside.
I have a question.
Yes.
So, because you're talking about age. So I have here, this is from the United States Department of Health and Human Services. It's called the National Vital Statistics Report. And in this report, it has a table of life expectancy. And that life expectancy, I'm happy to report that Connecticut, by the way, is 6th out of 50 states in DC. But what I found interesting is this. So the average age of a man is 77.7 years in Connecticut.
Average age or
I mean, yeah,
Life expectancy.
life
life expectancy, I apologize.
I was worried.
Yeah. I'm not that far away myself, you know, so 77.7 years for men and 82.8 years for females, okay? So when you look at that, that's like 5 years and 1 month, all right? So say somebody retired, so take a retirement age of 65. That's kind of a standard age. So if you took a standard age of 65, then the men live for 12.8 years, right? But the women live for 17.8 years. So they live 40% longer in retirement. How do you deal with that in your glide path? Do you consider sex? Because here it's clear that women, their life expectancy after retirement in the state of Connecticut is 40% longer. Do you make adjustments for that?
Yeah, absolutely. So one of the critical parts of our glide path is not just managing to retirement, but through retirement.
But it's
So we
through
manage
retirement.
30 years through retirement.
I didn't ask whether it's 30 years through retirement, since the average man only goes 12 years and the average woman goes longer than that by 40%. Do you change the glide path for males and for females? Yes or no?
Nope. So there's one glide path. There's one glide path for both sexes. And as we think of married couples, so oftentimes we take into account the entire household. So part of our demographic analysis is taking a look at the average investor persona and their average amount of wealth at retirement, but then their average amount of wealth through retirement.
But you did mention a demographic gentleman.
Yes,
Right.
Eugene Hahn, right?
Okay, so good old Eugene.
Yeah.
Well, what, just to interrupt quickly, let's say that this couple has the average experience and you, I think it's a safe assumption to say that the woman the spouse who lives longer would inherit the rest of the person's assets, right? And then you would adjust the asset mix according to what I want to say, the surviving spouse's, life expectancy, wouldn't you?
Well, what I'm
I mean,
wondering is,
that's,
say if it's a single woman. I mean, there's a lot of single people out there in the world, and all I'm saying is, if there's a single man and a single woman, I'm asking,
yeah.
is the glide path, I believe it should be different. And I'm asking them if they adjust for that, like I just said, if you have a single man and a single woman at 65 years of age and they retire, one, by these statistics from the federal government,
Yeah.
is gonna live 40% longer. And since they're gonna live 40% longer, should you make adjustments in your glide path for them?
So it's one of the reasons why we go 30 years through retirement, because we understand, number one,
I-
Americans are living
I
longer.
didn't ask what
Correct,
it
And number two,
Sorry to interrupt you, but, okay, let's say you're a guy. And
I
you,
am.
and you know that your life expectancy is going to be different. Couldn't you either do it yourself or direct your financial advisor to modify the target fund you're in? Because that'll have a different glide path.
Well,
Couldn't you do that? Isn't that the way to do it on an individual basis rather than to complicate the base scenario?
I didn't think it would be really complicating if it was just, there's only one adjustment made to it.
No, it's
That's all I'm
certainly,
asking.
it'd certainly be complicated, and can you imagine the legal risks they could potentially face if they had different glide paths for men and women, the hue and cry that would come up? I mean,
Life insurance policies are less for a woman than for a man. I haven't heard any
okay, all
uproar about
right,
that.
well,
so, part of the analysis is taking a look at 55 million census records, looking at coming through EBRI data and the Department of Labor data as well. So part of the reason why we're 30 years through retirement is that you want to solve for the folks who live either shorter and folks who live longer as well. So what we stress test our portfolios to identify is that, number one, can we support retirement income across a different spectrum? For folks who want to withdraw 3% or 5%, and how long would that last? So what's the longevity risk? So one of the key parts of preservation of capital, which is part of our objective, is stress testing the portfolio to understand what's the probability of you running out of money? Because I think where you're going with it is, as women do live longer, and we took that into account, what's the likelihood of them running out of money? And that's part of the stress test. So when we develop a persona, there is one individual persona, but this takes into account millions of records. So we have over 10 million individual plan participants, or nearly 10 million individual plan participants across about $300 billion of our target date strategy. And we created a glide path in our view that is clearly one of the glide paths that can fit the standard parameters of an individual, but people can't alt-date. So I take a look at myself, I should be in a 2050 glide path, but I alt-date to 2065 because I prefer something more aggressive. But for individuals, we've done thousands and thousands of simulations on different market environments and really trying to solve for longevity risk, because we understand that in retirement, running out of money is a critical part of what brings anxiety to retirees. So we did measure that.
You
my
know,
point would be to extend it beyond to
if you-
40 years versus 30
Well,
years.
you go
Because
on,
I'd be upset if I'm dead in 30 years.
well, by the way, if you have an IRA, right? And you have to withdraw from it. If you look at the tables that the United States government publishes, it goes out to 115 years. So just to make you aware that they plan further out than 30 years. But I'm just, I mean, you keep saying that, but, and you got millions and millions of people and you talk about 30 years or whatever. And the government of the United States goes out to 115 years. So that's longer than 30 years. And I'm just saying that like we have Eileen, who's on the board, and, you know, she's employed by the city, and her life expectancy perhaps is higher than a man who's working in the city. And that would only be, rather than putting the emphasis onto the person to try to change the glide path. Because one of the things is that we know that most of the people in the defined contribution, they're really passive investors. So I'm just
Is
saying,
that is that this firm's obligation, or is it Empower's obligation to advise people that their life expectancy is longer, and they should adjust their allocation to different, to a different target.
well, but would you,
And that's.
but do you agree that this
That's
should,
the,
this could be?
that's, if we believe in the baseline that's done, and we can understand the such as this glide path, and we can understand and get enough data or see what the, this glide path is an average sort of thing. What might help is the distribution around it. And then you say, okay, fine, I think I'm more on the right tail than the left tail. Therefore, as an individual, I need to adjust it rather than, I don't know how you could reasonably implement a blended guide, a more than a single glide path.
Yeah, I think to do that, you'd have to have almost two steps to this. First, you have to have a questionnaire, and this is probably something in the Empower platform, not these guys. When do you plan to retire, and do you expect you will live longer or less than your average life expectancy?
Well,
That's what you'd have.
I think to ask
Mr.
somebody
Chair.
how long they're gonna live might be a challenge, because, you know, everybody wants to live forever. But I do think that just like, you know, life insurance premiums are different, that, you know, to have a glide path with the assumption that it's a male or an assumption that it's a female, I mean, you know, with artificial intelligence, all I'm saying is there might be two glide paths rather than one. Is that so unreasonable? I mean, if you just told us how many millions of people you have and how many hundreds of billions you have. I mean, for God's sakes, you got enough, you're clicking enough
So
keys
you're
to do.
gonna double the number of funds you have?
Well,
No,
and there's,
No, I don't think you're
there's-
You're
changing,
gonna have an M and a W?
no, you're not, no, I never suggested changing.
Well, I'm
number of
not,
funds.
I'm not
Okay.
saying that you should,
Right,
I'm trying to figure
right.
out what the practical implications
The practical
of having
implication
two
might be
glide
to-
paths are.
Can I jump in with maybe a quick comment? I appreciate the question from the chair. I mean, but it's an average at the end of the day. I mean, it also doesn't take into account something that you mentioned a couple minutes ago, which is the fact that men are going to have different lifespans simply based on their health, right? The individual health. So these are averages baked in. There is an alternative solution here in the marketplace, which I can't believe I'm going to say it, but managed accounts, right? Every single individual can sign up and work with somebody to create their own specific glide path, if you will. That being said, they are more expensive, and they have been shown to be not as productive in terms of preparing individuals for retirement or during retirement. And that, you know, that we do have data to support that. So this is the best solution or outcome for the masses, but it is still very much an average, and you know, there's a lot of variations that could go into separating glide paths by sex, separating it by, you know, are you married? Are you not married? Are you trying to create something for a spouse? Your individual health level or matters or situation. So you could slice and dice it, you know, a number of ways beyond just simply sex, but it's really kind of getting away from the efficiency and effectiveness in, you know, from probably a cost perspective more than anything at the end of the day.
Yep.
I'd like to really ask how much of it, first of all, aren't some like 90% of the people in defined contribution in the passive fund like this, glide path, with a glide path on it? Isn't that the
Yes.
number? Yes.
Yes.
Okay, so it's like 90% of the people are doing that, all right? Number one. Number two, for example, an life insurance company doesn't break it down beyond sex. And when you talk about, well, it could be this and it could be that, but there are national statistics. And I think everybody agrees here that women live longer. So should they have a glide path that's different? That's
Yeah.
what I'm asking.
I think, Frank, just from an industry perspective, I don't know of any target date fund manager that has a glide path based on the sex of a participant.
And if I might jump in on that, Brett, that might be a good point to draw out here on our glide path. I don't know if we call it lucky to die shortly after retirement as a man, but you're gonna have the most amount of equity at that point if you're dying earlier in the glide path.
Yeah, well,
So typically what you would expect is if you're not gonna live very long in retirement, the expectation is to hold more equity. If you live a long time in retirement, what you want to see is a transition more to fixed income. Because that preservation becomes really critical as that leaky bucket keeps dripping water. And so that is exactly what we're trying to do. So we almost adjust this over time. If you die early in retirement, you have more equities in there to provide the growth. And then over time, if you do fall into that longevity situation, that fastest growing demographic, which is the 100+ crowd, you're going to have a lot more fixed income, but equities aren't going away because you could continue to live even longer. 30 years from now, what's the life expectancy going to be? Is the top end of this chart going to be 115, or are they going to push it out to 125? So the question is, how do these numbers continue to change over time? And we believe in this dynamic glide path we offer because it does adjust for all those eventualities over time and can continue to perpetuate into the future.
does your glide path take into consideration, just say the average of Connecticut?
Yeah, absolutely. Well, we're taking into the average of the entire country. So as we do conduct our demographic analysis, we're looking at, of course, mortality tables. We're looking at starting salaries. We're looking at, so one recent insight from our demographic work was the first 5 years after retirement, after 65. We found-
You're saying you do an average for the country, but not for Connecticut.
Right, the range of the country is 6 years from one state to the highest state to the lowest state. I'm just asking if.
No, we don't have glide paths for different states.
Oh, no, okay. Just so you know, whatever agency that is, there's 5 or 6 different government agencies with different life expectancies.
Yeah, this is the Department of Health and Human
But they're as
Services.
much as 5 or 6 years
Yeah.
apart. IRS, Social Security has their own numbers.
Right,
And depending upon, practicing, if you're trying to get a larger personal injury settlement, you use the one that had the 6 years longer settlement. 6 years longer life expectancy, and it is a significant difference. So whatever calculations they're gonna have to do could be extensive based on those kinds of differences.
okay, I was just wondering, plus I have, I have 3 daughters and a wife, and I gotta make sure that, I don't come across as a sexist here, so.
No, I understand. And longevity risk is what we found in much
Remember
of.
that, you guys are saying I'm supporting me, you're gonna.
No, my solution is for the individual, to understand their deviation from the glide path. I know the glide path, and I adjust it to my situation. For example, I may want to have the same a more aggressive spending pattern.
So can somebody adjust their, so like, say this sets at 65, you know, or whatever. Can somebody shift this, your glide path?
Yeah, someone can shift their glide path. And again, it's more about that normal distribution and the best fit. So there is not going to be a glide path that fits all demographics. I know managed account was mentioned before, there, you know, it's pros and cons of those items. But again, part of our analysis is understanding the goals of retirees, and longevity risk is one of the primary factors that we're trying to mitigate. And by doing that, included in our analysis is stress testing a portfolio. And when they're taking on distributions, how are those distributions and their overall wealth impacted by drawdowns or bear markets or bull markets? And that is an important calculus as to how we think about modeling the overall portfolio. So if you live longer or if you live shorter, our glide path in our view is the best fit for that average.
Okay.
I have a question, just, and I'm a little confused as far as how this works. And because the question almost is who actually selects like the target date fund that I want to be a part of? And I may be retiring, you know, in 5 years. So my impression is that you're offering different options. You're offering a fund that is like a 10-year fund kind of target, a 15-year fund, a 20-year fund, a 25-year fund. You have different funds. Then me as the individual, do I select which fund that I want to put my money into? And I guess the question is, do I do that with your consultation, or do I do that with Empower's consultation, or is that not how it works?
And Britt, can correct me if I'm wrong here, but as you take a look at slide number 11, it depends on your date of birth. So we receive that from the record keeper, and you're automatically defaulted into the appropriate target date vintage for your age.
Okay.
Yeah, Dave, so it's through Empower, and you know, if you're on their website, if you're registering for the Norwalk DC plan,
Okay.
you will enter in your birth date, and if you don't do anything, the city will default you based on your birth date into the age appropriate target date fund.
For a given retirement, for a retirement target date.
Exactly.
And that then slots me into a certain target date fund, so I'm part of that. And regardless whether I'm a male or female, I would get selected into the same fund.
Correct. And you can always go in and change it based on your circumstances to whatever asset allocation you want with the individual options that are offered in the plan.
So I may push it 5 years later or 10 years later at my own discretion based on.
Exactly. So for
on-
instance, I know it was said earlier, I'm in the target date fund in my 401k plan, and I'm in a riskier vintage because I feel like I can take more equity risk because I'm not planning to retire in the next 20 years.
Okay.
And if things were different and I felt the need to be more conservative, instead of being in the 2060 or 2065 vintage, I could move all of my money to the 2020 vintage or the 2025 vintage, which will be a completely different asset allocation and a much more conservative position.
And I could do that based on my own decision, or I could do that in consultation with someone from Empower.
Exactly.
Either way there.
Yep.
Okay.
So the
That helps.
participant has full discretion over where their money goes and what funds it goes into. But if they do not take any action, they will be defaulted based on their age and their date of birth.
Okay, so Frank, now given that, I guess the question is does the responsibility lie in the correct place, where it's the individual potentially in consultation with Empower to make a decision to override the default? And is the default wrong or not? I mean, is the default, you know, grossly wrong if it's not done by sex or not?
Well, first of all, by the way, when they were talking about having more and more money into bonds, you know, that kind of caused me like shudder, since that we know what our performance in bonds for the last 8 years has been less than 1%. But anyways, Empower could do something where, you know, basically just to say you're, as long as Empower would advise people to say, to discuss their longevity, right? So that basically to say, okay, I was born in 1950, and if a woman was born in 1950 at the same time, she could say, I want my glide path to be, say, set on an equivalent of 1955. Because she's gonna live there 5 years longer, so she's gonna have, and at least if Empower would advise people of such a situation of longevity, because I think it is an important factor. I mean, you know, I have a mother-in-law, she lives in this very lovely place in Garden City, and it's like, it's like the widow's hotel. I mean, there's all women there, and their husbands have preceded them, you know, and I just think that in this day and age, where there's more and more women working, there's a lot of women who are single, that they should be made aware that, and they're, I'm not trying to belittle them, but some people might, in general, many people don't have a lot of financial sophistication, and it should be either presented to them, or there should be a standardized adjustment, that's all.
Mr. Nash, is your primary concern the longevity aspect of it, of women living longer and
Right,
this not
so
managing
if-
out?
Right, so
more
if
than
they're
30
living
years?
longer, perhaps you should have them into, say, stocks for a longer period of time.
My concern would be that if they're automatically put into what the city considers age appropriate for a female in Connecticut using data from Mississippi, they're not gonna be in the correct.
Well, but
Age appropriate.
maybe the solution is to ask Empower to come up with a more sophisticated allocation, and a more transparent
Automatic
allocation
allocation.
process,
Yeah.
where someone can say male, female, and talk about their habits, as far as, you know, smoking, non-smoking, family history, and that sort of thing, or to modify, to come up with a suggested target fund rather than, or some way of doing a more than a, you know, put your finger in the air type of thing to come up with, well, I should be longer or shorter. And, you know, I'm perfectly fine with just having, as I've said, as long as we have a robust baseline, that then you can work off of that.
Right, yeah, you have a baseline, I agree with you, and then maybe you do have a question here, you know, you might just it might be shifted just because of male or female,
Or I live in Connecticut,
or I live in Connecticut,
or I
right?
expect to retire to Florida, I don't know what that does. but-
Well, I mean, we've done a lot of work. I mean, I even think about it in different sectors, right? There are metals and mining companies, and we know that those demographics are very different than maybe folks who are engineers, right? On average, the folks that are metal and mining companies, that are miners, probably gonna live a shorter life relative to the engineers. So there's a lot of analysis that goes in, but as we think of, again, that normal distribution across the records that we've used, you know, we've created a glide path that we think is quite durable and a very decent baseline for folks. And to your point, folks can off-date, but we can have further discussions on, you know, individually what we've done within the
I
analysis.
think all that Rich said, and what I'm trying to say maybe is not as well as Rich did, but that you should be able to adjust onto the glide path. That's what I'm asking.
Okay.
There's an infinite number of ways to calculate life expectancy. You know, your health, your occupation, where you live, you know, do you exercise? Did you smoke? Is there cancer in your family? That's not something for Capital Group to do, I don't think. And then, you know, maybe it's a discussion to have with Empower when we see them, but you know, I think probably I'll let Capital Group get back to their deck here.
But really, like, I mean, insurance companies do that. They ask you if you smoke, they ask you what your sex is, right?
Right.
They ask you what your habits, if you're overweight.
Yeah, but they're taking the risk, you're not.
Well, right, well, we're just trying to say that the people
But
here,
that's, you know, that's a different,
the people.
you know, they're underwriting your risk,
Right.
and the individual's not underwriting any risk other than themselves here.
Well,
So that's why
so their knowledge about what they should be doing, they're at risk if they.
I don't disagree with that, but that is a reason why your insurance company do this, because they're the ones taking the risk. These guys aren't taking the risk on you, or they're not taking the risk on me.
And we wanna
So-
make sure that the
Yeah,
people
yeah,
who
yeah,
they're
yeah,
using
yeah,
as
yeah, yeah.
clients are realizing
Yeah,
that there
and
could be
that-
risk.
And we should make sure Empower I think is the place to do that.
Yep. Okay,
We can kick off the slide 24 and hit a few more. Just for numbers
Yeah, go
as well. So just quickly, just running through the strategy. I know I believe it was Brent and Kevin covered the economic backdrop. So I don't think we need to hit slides number 20, but on slide 24, it takes a look at our strategy over the last 17 years and looks at the 6 correction periods and 3 bear markets. So I talked about the ability to build wealth, which is critically important in the accumulation phase, but this looks at how our glide path is done in markets that have been negative. So as you take a look at the far right-hand side, that's our average down market rank relative to target date peers. And if you look at the number on the bottom, that's shaded in gray, it's the 23rd percentile, meaning that in these 6 correction periods and 3 bear markets, we've fallen in the top 23%, so the top quartile of our peer group. So meaning that we held up quite well in these down periods. But I think the next slide, slide number 25, really kind of highlights our ability to add value when markets are up and add value when markets are down. So as you take a look at that scatter plot, it looks at our 2055 portfolio through our 2010 portfolio, where there is a 10-year upside and downside capture versus our average Morningstar peers. And we can continue to say that we're the only target date manager where all of our vintages exceed 100 on the upside relative to the average and do not exceed 100 on the downside relative to the average. So the quick math of that is if you have $100 and you're down 20%, for you to get back to 100 and break even, you need to be up 25%. So if we can mitigate those valleys and mitigate those down periods, it gives plan participants an advantage when markets recover. And then lastly, I would point to slide number 20.
How many are in your peer group?
In our peer group, it's over 100, and I can get the exact
No,
number
I
to
mean,
you
if it's
here.
over 100,
Yeah.
I'm good.
Yeah, so if you go to slide number
I'm
47.
wondering whether it's 4 or 5 or 15 or 20, over 100, I'm good.
Yep, so if you look at slide number 47, it gives you a breakout of the various bear markets. So the most recent bear markets, it's in the hundreds to 200, and then you can take a look at the peer groups on site.
Okay, thanks.
So as we fast forward to slide number, just looking at overall results, and I want to be sure I answer all your questions. But slide number 26 takes a look at our cumulative returns. So as you can see, calendar year 2023 was quite robust in terms of absolute market returns, returning from 21.5% to 8.6% in the 2010 portfolio. What you'll see with the percentile.
What slide are you on?
Slide number 26.
Okay, yeah. Sorry.
No worries. So as you take a look at the total returns quarter to date, primarily falling in the top decile quartile, we saw pretty robust market returns in the fourth quarter. But you'll also look at the 1-year period where the further dated vintages, some of those younger employees had fairly strong relative results. And if you think of calendar year 2023, where growth outpaced value by 31%, it kind of really speaks to our bias towards more growth-oriented companies. You will see the relative ranks of those folks closer to retirement are weaker relative to peers. But what we're doing is shifting to more dividend-oriented equities, which are supposed to be more resilient in down markets and tend to lag in up markets. But as you extend those timeframes, the 3-year, the 5-year, and the 10-year results, they continue to be strong, but even more so focusing not solely on the total returns, but the amount of risk that we're taking for the amount of returns that we're garnering. As you take a look at standard deviation to the right of it, in blue, you can see primarily what I would call a conservative to moderate risk profile, with ranks being in the top 2 quartiles, primarily the top quartile. And then lastly, how we think about ultimate success in, calibrating, building wealth and preserving wealth, Sharpe ratios, which is a measure of risk-adjusted returns. And as you can see, on a 3-year, 5-year, 10-year basis, those numbers continue to be quite industry-leading.
So what's the essence of your strategy? Is it based on stock equity selection? Is it the asset allocation? Is it certain hedging strategies? I mean, what's driving, those results?
Yep, so there are three sources of alpha generation in our glide path. The first source is our strategic allocation to US equities, non-US equities, and bonds. So that's what's our long-term historical average for those three asset classes broadly versus the benchmark and peers? That's number one. Number two is our bottom-up flexibility. So that's our approach to tactical. So it's portfolio managers making relative value decisions between US equities and non-US equities. Case in point, think of companies in the same industry like aircraft OEMs. You have Airbus that is based outside the US, Boeing that's based in the US. Those companies tend to be really strongly correlated with one another. I know Boeing has had their issues more recently, but portfolio managers make relative value decisions between US companies and non-US companies on an ongoing basis in a portfolio. And that's a critical cog to how we've been able to generate alpha. And then the last component, which is the most significant component, is security selection. So three sources of alpha generation: strategic allocation, our bottom-up tactical flexibility, alpha generation, and lastly, security selection.
Okay.
Do the managers get a, where does top down come in terms of, we want the overall to be 60-40 US versus non-US, then do we want, then you say, okay, I want this deviation from on a sector basis across, I don't know, whether S&P is your benchmark or Russell 3000, something more broad. We want to do this, and people get the individual portfolio managers then get to decide which names go into those different buckets. Is that how it's done?
Yep, so slide 17 gets to some of the flexibility. So I talked about our 8-person team and a research team behind them. We create strategic allocations to broad asset classes, but not only do we create a strategic asset allocation to those asset classes, we create strategic allocation ranges as well. So think of those ranges as guardrails.
Yeah.
So our 8-person team creates the target allocation, and we expect the underlying portfolio managers through their flexibility to oscillate within those ranges. So if Boeing is trading at 24 times and Airbus is trading at 19 times, oftentimes because of the thesis of individual companies, the lower PE company, the cheaper company from a multiple perspective. Or the same could be said for stocks versus bonds, where we use multi-asset strategies, where their next incremental dollar can be invested in equities or fixed income, depending on where they're finding the most value. So that's an incredibly important part of how we allocate capital, is to create this target allocation, but understanding that markets are really dynamic, and it allows us to adapt real time because the decisions are flowing through the bottom up, and the top down framework is setting those ranges and the target for folks to oscillate through. And very different than how other managers today allocate.
And in page 16 is the detail behind almost the chart on page 17.
Yeah, so page 16 are the details on the prior slide, on slide 15. So 15 recreates the glide path through a traditional asset allocation lens. And slide number 16 is at the end of the year, what were those specific asset classes?
And I mean, this doesn't show really any alternatives or any private equity. So you're basically in fixed income and also in equity and cash.
Yeah, so the way that we think about alternative asset classes are a couple of ways. So number one is you think of access to commodities. We don't own direct commodities in our strategy, but we do have our inflation-linked strategy that can invest up to 20% in commodities. We just haven't found a value there just yet. That's number one. Number two, we do have indirect exposure to commodities through companies like Vale or Freeport that are in the overall portfolio. And then we also have access to REITs, which are clearly liquid, strong correlation to the real estate market, but we don't have any direct real estate, private credit within our allocation. And largely, as we think of alts, we have alternative asset managers meet with us pretty regularly. And we have analysts that cover those specific strategies. And we found that kind of TLC has kept us away from the alternative space in our glide path. That's number one. The T is transparency, the L is liquidity, and the C is cost. And as we think of cost structure, especially within a QDIA, wanting to be sure that we offer compelling investment results at a reasonable cost for plan participants.
And Dave, I would just add, in general, alternatives are new to target date funds. I think the most prominent one is private real estate to a degree, but the dynamics of these funds having to be daily liquid make it very complicated to allocate funds within the glide path to illiquid asset classes. So it's certainly been a topic of discussion with target date managers for 10 years, but the actual implementation of it, I think there's a lot of hurdles there that still need to be met in order for it to be worthwhile.
Even for the ones that are 45, 40, 35 years out, even for those type of target date.
Even, yes, because if you were invested in that fund, you could move your money tomorrow to whatever fund you wanted.
That's why the
and
liquidity is so
Capital
critical.
Group would have to make the transition with the record keeper. So the fact that you can move your money at any point in time to a different fund or out of the target date funds altogether really causes that potential issue.
Okay. That's helpful. Thank you.
I guess ultimately, what I would leave you all with, as I think about our overall target date strategy, it is focused in on our dual objective of building wealth and preserving wealth, and that's a really delicate balance. And that younger plan participant, they have much lower financial capital and high human capital. So we want to be sure that we can grow their wealth, and we're doing that through, our top-down asset allocation, but then also the strength of our underlying building blocks. But then also, as folks get closer to retirement, downside protection is critically important. And that's not solely by lowering the amount of equities, but it's about changing the types of equities. And if you take a look at 100 years of market data, dividend paying companies, and especially companies that are growing their dividends, historically have been less volatile than broad market.
Any other questions?
No, good presentation. Thank you.
I have one more question.
Sure.
When we look at the target date funds, what benchmark, I should know this, and I apologize, but what benchmark are we looking at to compare how well the funds are doing? And is it one benchmark per, or is it segmented in terms of some kind of composite benchmark for each of the funds? How does that work, and how do we evaluate that?
Yeah, but I'll let Britt and Kevin chime in terms of how they evaluate it. As we think of in our own internal benchmarks, there are three ways that we look at it. Number one, relative to our own custom target date index. Number two, relative to the S&P target date index. And then number three, oftentimes compared to our peers. And those are kind of the three ways that we think about benchmarking our strategy. There are a variety of different target date glide paths in the industry. Everyone somewhat does it somewhat differently. So that's how we gauge success, is ultimately kind of through those lens, but then also just the investable universe. How are we doing relative to other managers? And how are we, is our ability to build wealth and our ability to preserve wealth and ultimately get plan participants to a more optimal outcome? Is that better than what's available in the marketplace? But it really is those three prongs that we look at.
And we're doing the same thing on our side. We're utilizing the appropriate American Fund vintage index. And then we're also, and not because we don't trust Cap Group's peer group, but just gosh forbid, they're cherry picking to make themselves look good. We utilize Callan's target date fund peer group. And that's in the quarterly report, which we'll touch on later, I think, where you can see.
Yeah, I see that page 35 now.
Yeah.
So there's the Callan target date fund. Those target, or those benchmarks are based on accumulation and averages of target date funds that your clients have. Is that what that is?
That's the median peer for each vintage.
Right.
So
Each vintage.
So, the target date fund index, which Capital Group has, is basically, based on the asset allocation of, say, the 2030 fund, Capital Group develops a benchmark based on that asset allocation. So just like the pension fund total benchmark has X amount to equities, X amount to fixed income, these benchmarks correlate to how the asset allocation with each vintage is set up. So you can see if they outperform because they implement with active managers, that means that their active implementation has been rewarded over the passive benchmark. And then we look
Okay.
at the median peer to see, how does Capital Group compare to other target date fund providers out there?
There's a peer comparison. That's really that's the benchmark basically in that case there.
Yep.
Okay, thank you.
Any other questions? Thank you, John.
Thank you.
Thank you.
Thank you.
Kevin, Britt, thanks so much.
you.
Members, thank you.
Thanks very
Appreciate
much.
the time. That was great Q&A. Let you guys get back to business.
Rick? So we'll go performance review on this? On target date funds at all, or anything about the defined
Yep, Kevin.
contribution?
Kevin's
Yeah.
gonna run us through performance.
Yeah, I'll take maybe just quickly through performance. And Dave, some of this will maybe get to your last question there. So maybe just sticking on page 35 in the quarterly report. This is the Q4 report. The American Funds, Cap Group, TDFs, they performed really well in the fourth quarter. Maybe that shouldn't be surprising given the fourth quarter rally that we had and the fact that American funds are active and they are overweight domestic equities in particular. So each of the vintages did really well. They outperformed their respective benchmark. They also all finished ahead of their median peers. And interestingly, all but 2 were top quartile and 6 of them were actually top decile. So performance has been really, really strong in the fourth quarter, but also over the last 3 to 5 years as well. So I think hopefully everybody's really pleased with how they're doing. The domestic equity asset class was really the main driver, along with security selection across all of the vintages. On the flip side, fixed income security selection was negative across all the vintages and particularly weak in vintages near retirement. So, pros and cons are not always going to get it right, but again, that's why you have sort of the diversified portfolios in the glide path there. If we jump ahead,
Sorry, Kevin, were you saying that they lost alpha on fixed income? Is that what you just said?
they lost. Yeah, so if you were looking at the breakout, that's right, Rich. The stocks. So fixed income as an asset class was up in the fourth quarter. So the asset allocation effect was positive. However, on a security selection basis, they lost alpha. That was a detractor.
Not surprising.
Well,
Yeah.
you don't know what they're picking, so.
We don't know what they're picking, so maybe I wouldn't say it's not surprising, right? You never want to, just like some of your active managers on the core menu, who are equity, had poor security selection and lagged the index, right? So it's not necessarily just because that particular asset class was up or down, they did well. It's the skill of the manager at the end of the day for any given period of time that we're looking at. There wasn't deeper color in terms of what exactly was driving that security section within fixed income. I'm happy to go back and ask, whether it was a particular sector within fixed income or something to do with, you know, where they were on the yield curve perhaps, but overall it was a detractor.
How do we see that's not on page 35, obviously.
It's
No.
not on page 35. You know, that's something that we could probably share with you where we get quarterly attribution from Cap Group with respect to these this particular target date fund.
And these are actively managed funds, obviously. What's the expense ratio for these funds?
I'd have to pull it up for the R6 share class.
It's on page 46 of the report. So the fees, there's a range of fees depending on the vintage, but the average expense ratio for the funds is 34 basis points, which ranks near the bottom quartile of the peer group. So the cheapest peer group, Capital Group, is known for having very competitive fees across their strategies, and this target date fund also has extremely competitive fees.
Good.
Okay.
That was one of the reasons why we selected it.
That's right.
Right.
Yep.
It's a consideration.
Page 36, just turning there, just taking a look at the passive funds. All of them continue to track their respective indices, their benchmarks closely, which ultimately is exactly what we want to see. You will see some deviation over the shorter term periods, like a quarter, a year, but hopefully when you look at it, the 3 to 5 year periods, they're very, very in line with one another. That's that, you know, tight tracking error that we ultimately are looking for there. Within the active, you know, options on the menu, equity side of things, a little bit more challenging in the fourth quarter. You know, you take a look at managers like JP Morgan Equity Income Fund, as well as MFS Large Cap, and you know, they were quite a bit behind their respective benchmarks there. A lot of this had to do with the reaction to interest rate news in the fourth quarter. You know, we did see a rally in very rate sensitive sectors like consumer discretionary, financials. They all rallied on anticipations of a soft landing. A lot of equity managers are perhaps underweight some of these areas. You know, additionally, you think of something like the materials sector, which, you know, really rallied as well, as the expected drop in rates is reducing the cost of carrying inventories. Materials is going to be something typically a lot of active managers will be underweight in. So they were victims, if you will, by the announcement in late October, early November, you know, Fed expecting to cut rates in the coming year. And so, you know, we did see that relative underperformance, but over the longer periods that, you know, the managers have continued to do well versus, you know, the peers in particular. Some of these indices have been harder to keep up with than others, but, you know, relative to peers, they've been competitive. On the fixed income side of thing, a manager that you're all hopefully very familiar with, which is TCW Met West. They actually had a really strong fourth quarter. If you recall, a lot of the underperformance in more recent times has been around the duration position, and they were a big beneficiary of that, given the fund's communication during the quarter. So, you know, they remained longer than the index throughout the year, and after they had moved to an overweight in 2022. So that was a big benefit to them during the fourth quarter. So we're happy to see that kind of come through, and you know, see what happens in the coming months here as rates continue to be in the spotlight. And the last thing, maybe I'll just mention, you know, which is stable value. It looks very competitive versus the peer group. You might be wondering, okay, why is it so far behind, like the 3-month T-bill? Stable value funds, for those who may not be familiar, they reflect changes in the interest rates more slowly than money market funds. So, you think about in 2022, money market funds began generating really competitive yields as a result of what was a historic response by the Fed in terms of trying to stem inflation and hiking the benchmark interest rate. And so stable value, as expected, has underperformed money markets following that hike in rates. We would expect this, frankly, to continue over the near term, just given how quickly rates have risen. But we do think that it'll ultimately kind of wash through, if you will. Stable value will catch up, and there's benefits to being in stable value over money market fund. You look back, long-term performance is certainly stronger, but also there are pricing smoothing mechanics at play and wrap contracts and things like that stable value has built in. So even though the shorter term numbers might look like they're struggling a little bit, we still favor them as a preferred vehicle here over the long term.
How long do you think it will take them to catch up?
Yeah, I mean, it's tough to say, just given how much more rates potentially bounce around, right? I think we're getting.
It's going to be more. So okay, it's more than 3 months, but is it less than 5 years or 10 years? I mean, I'm trying to bound the problem here.
Yeah. Less than 5 years. I would think less than 3 years. I mean, we're, call it 12 months in terms of like this sort of, it's not tracking error, but we're 12 to 18 months kind of experiencing this disconnect. I would hope that in the next year or two, this sort of right sizes itself as they kind of, again, just catch up with the change in rates.
And then they would have to outperform for 3 to 5 years to catch up on the total return?
Not necessarily. I mean, the longer term numbers are there, right? And so
it's let's see, 5 years, they had 20 basis points, and then they're behind on 3 years by 7, 22 basis points. They're about even, they're about 100 basis points behind on 2 years.
Right. Yeah, the magnitude of the last year, where they were essentially half of the performance of the money market. Once that rolls off, I think you'll see sort of that repricing coming into effect, and the longer term numbers will be that much stronger. It's tough when.
Yeah, we don't have much. There's not much money in stable value funds in our plan.
Right. That's a good thing ultimately. People aren't just necessarily parking it in cash. So yeah, there's not a ton of concern there from a participant level.
And we've seen some periods like this over the years with stable value versus money market funds. And, it is expected that stable value will lag in an environment like we've seen. But over the long term, even despite this historical interest rate hike that we saw, over the long term, it still has outperformed. And really, we believe it's for a long-term participant saving for retirement. We believe this is a more optimal vehicle than a money market fund.
Yeah. I'm sure you looked at whether it's better than something to invest in 3-year bills or 6-year or 1-year bill.
Yeah, it's a lot of point in time discussion too. But we've had a number of discussions with clients on this. I'm happy to send materials to you, Rich, if you want to review them. Really just taking a deeper look at stable value versus money market funds, if you're interested.
Hey, Kevin, just a question on some of the target date performance slides.
Yeah.
What's the second line there? The target date, fill in the blanks, LDX.
IDX index. So that's the
Index,
American
okay.
funds. Yeah, that's the
Okay.
benchmark that they, right, okay.
Okay, got it. Okay, that's their benchmark versus, and the one below that's yours.
Yeah, the one below it is our the peer group.
Got it. Yeah,
right.
got it. Okay.
Yeah, on your offer, Brett, if we start to see more people put money into a stable value fund, maybe be something to look at, but we just don't have that much assets right now or flow into them, so
Okay.
I don't want to make you do work at me and Gord.
Well, we already have the materials, so it's easy to send an email.
Right.
What's our thinking or rationale or pros and cons for offering all these options, or eliminating options? I mean, what's the thought process that goes into that?
In terms of the number of options?
The number of options, and I mean, as opposed to just offering target date funds, right? But we also have these passive funds, the active equity funds. You know, what's our thinking around that, and how is it, I guess, beneficial or any downside if we didn't offer certain things?
Well, so I say from a high level, one thing there's been studies done outside of, you know, the investment industry that more choice, more options actually leads to worse outcomes. So,
Okay.
you know, when you think about like the KISS acronym, like keep it simple, stupid, for
Yeah.
excuse my language, that actually plays out here in all, you know, kind of like periods that we've looked at for performance. And in terms of having varied options, I mean, there still are constituents, participants who want the ability to do it themselves ultimately. And so that's what we're trying to do, but we're trying to do it in somewhat of a controlled manner in terms of not allowing them to access options where, you know, they're more volatile, or not having them, you know, take on too much risk at any point in time during you know, their retirement planning. So, you know, we try to avoid things like having a standalone emerging market equity fund, for instance, right? Or an individual commodities fund or something like that, where there's a lot of inherent volatility. We try to take that off the table, but still allow them, if they desire, to create their own glide path, kind of going back to you know, some of the discussion we had earlier this evening.
And one of the things we did too, Dave, when we were converting into Empower, was that we tried to map what current people had into various alternatives, so that if somebody, if we had a certain amount of money that people had in a S&P fund. And so, you know, we put that option there to let them go into that, or a large cap growth. You know, there were plan participants who had those investments already. So we wanted to not, it was traumatic enough to change their manager. So we didn't want to add too much more trauma to them.
Yeah, Dave, just to give you an idea, so when the city, we did a record keeper search with the committee and selected Empower, we did what we call an investment structure analysis, which is really laying out the lineup, understanding what options are going to be offered to participants. And the idea here is, one, we offer the target date funds, which is do it for me. You know,
That makes sense, yeah.
you invest in one fund, and then you want to offer core asset class options so that a participant can build a diversified portfolio themselves, if that's what they elect to do. And that's where you see US equity, large cap and mid cap, international equity, fixed income, and then capital preservation, which is the stable value fund. And given the discussion on fees and the concentration on fees, we're able to provide a passive low cost option to build your own portfolio, and an active option to build your portfolio if participants want to go active. And one of the projects we will be presenting to the committee in the fall is to review the investment structure analysis of the DC plans, make sure that the committee is comfortable with what options are being offered. And if any need to be eliminated or added, we can do so through that analysis. But in general, we think this lineup is a really great streamlined lineup. And, you know, it came from plans that offered hundreds of options, which as a participant is overwhelming and does not help them save for retirement.
I would agree. It's
You know,
almost like the passive funds, you have the S&P 500, then the international and the bond, and then you have the stable value. It's almost, that's almost like complicated enough besides the TDF funds.
But the thing too is the idea of the defined contribution is that it's self-directed. And if we
Yeah.
had said to everybody, you can only go into this one fund, this target dated fund, then in effect, you're taking away their
options.
opportunity to direct it themselves. So that's one of the reasons why we have other options for them. Because we as a board do not give advice on where people should put their money in this defined contribution plan.
Good point.
Thank you.
Any other discussion or any other questions? If not, is there a motion for adjournment?
Move through there.
Is there a second?
Second.
All in favor, aye.
Aye.
Opposed?
Aye.
Thank you very much.
All right.
Thanks, guys.
Thanks, everyone.
Thanks, everybody.
Have a great
See you
night.
next month. Yep.